Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow.
Hello, ladies and gentlemen. A warm welcome back to the special weekend edition of Markets Around the World. My name is K2, and as always, we'll be covering everything from the latest data and macroeconomic news stories to the key levels you need to be watching. If you're as passionate about the markets as we are, be sure to subscribe and deepen your understanding of how these markets work together. In this video, we'll cover a lot of important data, news, and macro trends. So, let's dive into what happened in the markets this week and discuss the outlook moving forward. Let's start with the latest news. A Federal Reserve interest rate cut in September now seems almost certain. However, how stocks might react to such a move remains unclear. In theory, lower interest rates should boost stock prices, as they usually lead to reduced borrowing costs, allowing companies to retain more of their earnings, according to Callie Cox, chief market strategist at Ritholtz Wealth Management. Rate cuts also make stocks more attractive compared to bonds by driving bond yields lower, since bond yields move inversely to bond prices. Last week, Federal Reserve Chair Jerome Powell indicated it's time to start cutting interest rates, leading many to expect the Fed will begin a rate-cutting cycle in September. However, investors are speculating whether the cut will be 25 or 50 basis points. The CME's FedWatch tool shows a 65.5% chance of a 25 basis point cut and a 34.5% chance of a 50 basis point cut. While a larger cut could boost the economy by easing money flow, it might also unsettle investors who see it as a sign that the economy needs significant support. Bank of Japan Deputy Governor Ryozo Himino reiterated on Wednesday that the central bank would continue raising interest rates if inflation remains on track, while closely monitoring financial market conditions. His comments align with Governor Kazuo Ueda's recent statements that market volatility won't alter the bank's long-term plans for rate hikes. However, Himino emphasized the need for utmost vigilance in monitoring the unstable financial markets during a press conference in Kofu, Japan. Trump's new NFT collection, his fourth, features 50 NFTs priced at $99 each, including images of him as a boxer, wearing gold sneakers or surrounded by American flags. The former president has earned over $7 million from his previous 3 collections. One NFT shows Trump holding a Bitcoin logo, signaling his appeal to cryptocurrency voters as he campaigns for the White House in November. Cryptocurrency policy has become a key theme in the 2024 election, with Trump now supporting the industry he once criticized as a scam. Meanwhile, Vice President Kamala Harris's team has been in discussions with industry leaders, according to Coinbase's chief policy officer, to address perceptions that Democrats are anti-crypto. NVIDIA Corporation CEO Jensen Huang was unable to fully alleviate Wall Street's concerns on Wednesday, as the chipmaker's growth slows due to a slightly delayed new product launch. NVIDIA reported better-than-expected fiscal second-quarter earnings and revenue, but its third-quarter forecast did not surpass Wall Street's consensus estimates. As a result, shares fell nearly 7% in after-hours trading, potentially marking its worst post-earnings performance in 2.5 years if the trend continues. The slowdown comes after 2 years of strong growth driven by AI-focused data center sales. Growth rates for gross margins and data center sales declined sequentially from the fiscal first quarter. A key issue is the delay in volume production of NVIDIA's next-generation chip family, Blackwell, due to a mask change to improve production yields. The company now expects Blackwell to ramp up in the fourth quarter, rather than the third. Economists at the Bank for International Settlements, BIS, investigated what caused the global market meltdown on August 5th, and found that despite the turmoil, markets held up well. However, they cautioned that the underlying issues remain unchanged, and the risk of another sell-off persists. The BIS team noted that many of the leveraged bets that contributed to the initial sell-off are being repeated, and risk-taking in financial markets remains high. While some trades relying on low volatility and cheap Japanese yen funding have been partially unwound, others involving more illiquid assets are unwinding more slowly. Federal Reserve Bank of Atlanta President Raphael Bostic suggested on Wednesday that it might be time to move on rate cuts, as inflation has decreased more than expected and unemployment has risen. However, Bostic emphasized he wants to see further confirmation from upcoming jobs and inflation reports before the Fed's September 17th to 18th meeting to ensure these economic trends are consistent. Warren Buffett's Berkshire Hathaway recently sold $982 million worth of Bank of America shares, reducing its ownership by 13% since July and earning $5.4 billion. While Buffett hasn't explained the reasons for these sales, they mark a notable reduction in a long-term investment. Despite this, Berkshire remains Bank of America's largest shareholder, holding 903.8 million shares. Apple is eliminating around 100 positions within its digital services division, affecting teams focused on Apple Books and Apple News. This restructuring is due to a shift in priorities, moving away from a heavy emphasis on Apple Books. Despite these job cuts, services remain a crucial part of Apple's business, accounting for over 22% of its revenue. Government bond markets, which have seen solid price gains this summer, are now facing a test of their expectations for quick central bank rate cuts, slowing inflation, and a tight U.S. presidential election. Benchmark 10-year U.S. Treasury yields are on track to end August nearly 30 basis points lower, their biggest monthly drop this year. This drop is driven by expectations of faster rate cuts, even though recent economic data has lessened fears of a recession sparked by the last U.S. jobs report. Let's dive into more data to see what's unfolding in the market. Historical pumps and dumps. Following Fed rate cuts. The data and charts below illustrate the price action of the S&P 500 SPX after Federal Reserve rate cuts in markets where certain economic conditions are present. Rising unemployment, top right chart. A declining U.S. economic leading indicator, bottom left chart. And an inverted 10-year, 2-year yield curve, bottom right chart. Key historical data. July 20th, 1989, plus 5.26% in 25 days, minus 20.93% in 185 days. 285 days, July 13th, 1990, plus 1.24% in 2 days, minus 20.17% in 88 days. January 3rd, 2001, plus 8.15% in 28 days, minus 39.9% in 644 days. September 18th, 2007, plus 6.56% in 23 days, minus 54.52% in 538 days. March 3rd, 2020, plus 1.06% in 1 day, minus 29.06% in 20 days. Averages, plus 4.45% over the first 25 days after the initial rate cut, minus 32.92% over the following 335 days after the initial rate cut. The real stock market. Turning point, a recession. The true turning point for the stock market is likely to occur during a recession, which would be indicated by two key signals: rising unemployment and a steepening yield curve. These conditions were also present during the recessionary bear markets of the past, such as the dot-com bubble, the financial crisis. As of now, these conditions have not yet been met. Another significant decline in the goods trade balance. The latest data shows yet another notable decline in the U.S. goods trade balance, highlighting the ongoing fiscal and current account deficits faced by the government. Running a double-digit twin deficit might be manageable when debt levels are low, but it's a different story when the country is historically over-leveraged and the Federal Reserve's interest rate policy far exceeds the government's debt servicing capabilities. Something has to give. In my view, the path of least resistance remains structurally negative for the US dollar. White-collar employment. Weakening employment in the professional and business services and financial and information industries rose just 0.6% year-over-year in July, marking the slowest growth since March 2021. This equates to an increase of only 126,000 jobs over the past 12 months. White-collar job growth has been on a steady decline for the past 3 years. Historically, such a significant drop has only been observed during the 2000 to 2001 period, the 2008 financial crisis, and the 2020 pandemic. The U.S. labor market is showing signs of weakening. Market concentration reaches .com bubble levels. Market concentration has surged to levels not seen since the 2000 .com bubble. As of July 2024, the technology, telecom, and healthcare sectors collectively represent a record 45% of global stocks. This marks a 10 percentage point increase over the past 4 years, surpassing the previous peak of 44% during the .com era. In contrast, the share of financials, energy, and materials in global equities has dropped to 25%, falling below the levels observed in 2000. Historically, after 2,780, the .com bubble burst 24 years ago. Tech, telecom, and healthcare stocks lost their dominance, while financials, energy, and materials gained ground. Will history repeat itself this time? Cash reserves for S&P 500 companies at record lows. The percentage of cash relative to total assets for S&P 500 companies fell to 8.8% in July, the lowest level since 2009. Over the past 4 years, this figure has decreased by 4 percentage points from near multi-decade highs, approaching the 2008 financial crisis low of 8.0%. With companies having spent a significant portion of their excess cash, future dividends and share buybacks may be constrained. This suggests that firms might prioritize rebuilding cash reserves over returning capital to shareholders. Could record stock buybacks soon come to an end? Rate cuts. Ahead, what to expect for stocks. Historically, rate cuts have had a positive impact on stock performance. Over the last 70 years, large-cap stocks have averaged a plus 15.6% return within 12 months of the first rate cut. Small-cap stocks have averaged a plus 26.6% return within the same period. Within 6 months of the first rate cut, large caps gained plus 9.4% on average. Small caps gained plus 14.2% on average. However, during the 2007 recession, the performance was notably poor. The S&P 500 and Russell 2000 fell 24% and 16% respectively in the 12 months following the first cut. In contrast, during the 2001 recession, small caps outperformed, gaining 2%, while the S&P 500 fell 14%. If the Fed can avoid triggering a recession, history suggests that more upside could be on the horizon. U.S. home prices reach new highs. In June, U.S. home prices surged 5.4% year-over-year, setting a new all-time high. The Case-Shiller Home Price Index, which monitors single-family home prices, has risen 51% over the past 4 years. This increase surpasses the 49% rise seen during the 2000s housing bubble, 2002 to 2006. The index for the 20 largest cities also climbed 6.5% year-over-year in June, reaching a new record. When adjusted for inflation, home prices are approximately 100% above the 130-year average. The housing bubble continues to expand. Richmond Fed Manufacturing Index hits pandemic low. In August, the Richmond Fed Manufacturing Index fell to negative 19 points from negative 17 in July, marking its lowest level since the 2020 pandemic. This index, among the 5 regional Fed surveys, correlates strongly with the nationwide ISM PMI Manufacturing Index. The Richmond Fed Employment Index also dropped to negative 15 points, its weakest in 4 years. Additionally, the Philadelphia Fed Business Outlook and Texas Service Sector Outlook both reported contractions in August. These declines suggest a deeper contraction in the manufacturing industry and worsening conditions in the services sector. Leading indicators point to further weakness in economic activity. U.S. homebuyer sentiment continues to decline. In August, the Conference Board Consumer Confidence Index for housing dropped to 4.1 points, its lowest level in 11 years, and the second weakest reading since the post-2008 housing bubble burst. The 6-month moving average of the Home Purchasing Plans Index also fell to a new 12-year low. Concurrently, mortgage demand has plummeted to its lowest levels since 1995, while home prices continue to hit record highs. For many, buying a home is becoming increasingly out of reach. All right, let's take a look at heat map of S&P 500 for this week. NVIDIA finished the week up 7.73% after reporting earnings. Microsoft closed flat for the week. Financial sector, XLF. Overall, the sector was green and ended the week strong. Alphabet and Meta both were down 1.27%. Tesla declined 2.82% for the week. Apple gained 1%. Interestingly, despite the mixed performance of these major stocks, the market closed near new highs. Fear and Greed Index update for this week. This week, the Fear and Greed Index has shifted back into the greed territory, currently standing at a level of 63. This shift occurs even in the wake of NVIDIA's recent earnings report, which seemed to have a mixed reception in the market. The Fear and Greed Index is a popular tool among investors to gauge market sentiment. When the index is in greed territory, it indicates that investors are becoming more optimistic, potentially driving stock prices higher. However, a move into extreme greed can often signal that the market is overbought, increasing the risk of a pullback or correction. As we approach September, the market could continue to climb, but it's important to watch out for signs that extreme greed is setting in. If the index moves further into this zone, it could precede a significant drop, especially with potential catalysts on the horizon, such as Federal Reserve decisions or unexpected economic data releases. Investors should remain cautious and consider whether current levels of optimism are sustainable or if a market correction is looming. Will we see the index reach extreme greed levels before a major downturn in September? Only time will tell, but the current trajectory suggests that investors should be prepared for increased volatility in the weeks ahead. Here's a quick overview of the earnings schedule for next week. Remember, the stock market will be closed on Monday for Labor Day, so keep that in mind when planning your trades. If you want to have this earnings calendar for reference, feel free to pause the video and take a screenshot. Let's dive deeper into the 4-hour chart analysis for the S&P 500 ETF SPY. As it stands, there hasn't been a significant shift in the technical outlook. Bulls continue to maintain their advantage. For those watching the market closely, it's important to note that the price is currently trading within a well-defined channel. This channel has served as a strong guide for market participants, indicating the boundaries within which the SPY has been oscillating. The upper boundary of this channel is around the 565 level. If the bulls are to extend their control and continue their upward momentum, we need to see a decisive gap up above this 565 level. A gap up and sustained trading above this point would signal a clear victory for the bulls, potentially triggering further buying interest and a continuation of the uptrend. On the flip side, bears are eyeing a different scenario. To capitalize on any potential market weakness, they are looking for the SPY to break below the lower boundary of the channel. The critical level to watch here is 549. A move below 549, especially if accompanied by strong selling volume, would suggest that the bears are starting to gain traction. Such a move could provide a viable shorting opportunity, indicating that the market might be ready to reverse course or at least undergo a significant pullback. September is a particularly intriguing month to monitor. Historically, September has been known to be a weaker month for the stock market. Many traders and investors are well aware of this seasonal pattern and are positioning themselves accordingly. If the market follows historical trends, this could be a favorable month for the bears, with potential for increased volatility and downward pressure. However, as always, Past performance is not indicative of future results, and the current market environment, influenced by macroeconomic factors and central bank policies, could defy historical norms. Overall, the battle between bulls and bears continues, with key levels in focus. As we move deeper into September, it will be critical to watch how the market behaves around these pivotal points. Will the bulls break through and push the market to new highs, or will the bears finally seize control and drive the market lower? Only time will tell, but it's shaping up to be a fascinating period for traders and investors alike. Stay tuned, and let's see how the market unfolds. Let's shift our focus to the 4-hour chart for the Invesco QQQ Trust, QQQ, which tracks the Nasdaq 100 index. Currently, the chart presents an interesting setup that could favor the bears as we head into September, a month historically known for being tough on the stock market. The pattern to watch here is the potential formation of an ABC corrective wave. In technical analysis, an ABC pattern is a common corrective structure within a downtrend or after a significant upward move. It consists of 3 distinct price movements: an initial decline, A wave, a retracement or partial recovery, B wave, and a final decline that often surpasses the low of the A wave, C wave. The completion of the ABC pattern could signify the continuation of a downward trend or a corrective phase within a larger bull market. As we approach September, a month that has statistically been the most favorable for bears, it seems increasingly likely that this ABC pattern could play out. The A wave may already have been completed with the initial decline we've observed recently. If the QQQ has been in the midst of a B wave retracement, we could soon see the C wave materialize, leading to another leg down. The start of the C wave would be confirmed by a break below the recent lows set by the A wave. If the QQQ starts showing signs of weakness and breaks below these levels with increased selling pressure, it would indicate that the ABC pattern is indeed unfolding. This scenario would present a prime opportunity for the bears to capitalize on further downside movement, especially given the broader market context and the historical performance of the market in September. However, it's essential to remain cautious and attentive to how the price action develops. While the setup seems favorable for bears, markets can always surprise. We could see unexpected bullish momentum that invalidates the ABC pattern, especially if there are any positive catalysts or favorable news events. In conclusion, as we move deeper into September, keep a close eye on the 4-hour chart of QQQ and watch for confirmation of the ABC pattern's completion. If it plays out, it could signal a significant shorting opportunity and further downside for the tech-heavy index. Stay vigilant, and let's see how this scenario unfolds in the coming days and weeks. Let's review the key economic events scheduled for next week. Monday, the markets will be closed in observance of a U.S. holiday. Tuesday, we'll see the release of the ISM Manufacturing PMI, which provides insights into the manufacturing sector's performance, and the Atlanta Fed's GDP Now estimate, which offers a real-time forecast of U.S. GDP growth. Wednesday, the JOLTS, Job Openings and Labor Turnover Survey, report for July will be released. This report provides valuable data on job openings, hires, and separations, shedding light on the labor market's health. Thursday, the ADP Non-Farm Employment Report will be published, giving an estimate of private sector job growth. Additionally, initial jobless claims data will be released, indicating the number of individuals filing for unemployment benefits for the August. Friday, the most anticipated news of the week will be the release of the Non-Farm Payrolls Report, which provides a comprehensive overview of employment changes in the U.S. economy. Alongside this, the unemployment rate will be announced, offering insights into the overall employment situation. All right, ladies and gentlemen, that's all for this weekend's video. I hope you found it valuable. If you did, please like and subscribe. If you have any questions, feel free to ask, and I'll get back to you as soon as possible. Thank you for watching, and I'll see you next time. Bye for now.